It took less than 6 hours. A $25,000 account, built up carefully over the better part of a year, gone in a single trading session. Not from one catastrophic trade, from a specific sequence of individually small, individually justifiable decisions, each one making the next one feel slightly more reasonable than it actually was. I'm walking through the entire sequence today, every decision, in order, exactly as it happened, because the actual mechanism behind a blown account almost never looks like a single moment of obvious recklessness. It looks like a chain. If you've ever had a single bad trading day spiral into something far larger than it should have, a manageable loss that somehow became an account-ending one, you've experienced the early stages of exactly the sequence I'm about to walk through. Most traders who blow an account don't do it through one decision. They do it through a chain of 5 or 6, each one feeling, in the moment, like a reasonable response to the one before it. Decision 1, trading a setup slightly outside my actual edge early in the session. The morning started with a setup that was close to my tested criteria, but not quite a full match, slightly different volume profile than my actual rules called for. I took it anyway, reasoning that it was close enough. This is the first decision in the chain, a small deviation from a defined edge, justified by a feeling, rather than the actual written rule. Decision 2, holding past my predefined stop when the trade went against me. The trade moved against the position relatively quickly. My predefined stop, decided before entry, would have closed it at a manageable loss. In the moment, I moved the stop further away, specifically because the trade felt like it was about to reverse the exact disposition effect pattern covered in an earlier video, holding a loser longer, specifically to avoid realizing the pain of closing it. Decision 3, increasing position size on the next trade to make back the loss. Once the first trade closed, at a larger loss than originally planned, I took the next setup at roughly double my normal position size, not because the setup itself was unusually strong, but specifically to recover the prior loss more quickly. This is the revenge trading mechanism, sizing decisions driven by the emotional need to recover a previous loss, rather than by the actual statistical merit of the current setup. Decision 4, abandoning the predefined stop entirely on the larger position. With a larger position now open, and already showing an unrealized loss, the prospect of closing it at that larger stop, given the doubled size, felt disproportionately painful. I removed the stop-loss order entirely, telling myself I would manage it manually, which in practice meant having no actual predefined exit at all on the largest position of the day. Decision 5, adding to the losing position as it continued moving against me. As the position continued moving further into loss, I added to it at a worse price, specifically reasoning that this would improve my average entry price. If the market eventually reversed, a classic and statistically dangerous averaging down decision made under the exact emotional pressure that degrades real-time judgment most severely. Decision 6, continuing to hold through a margin call warning, hoping for a reversal that never came. By the time the account received a margin warning, the position was large enough and far enough underwater that closing it meant accepting a loss that had grown to consume a large majority of the account's total equity. I held, specifically hoping for a reversal, until the position was eventually liquidated by the broker's risk system rather than by my own decision. 6 decisions, each one, viewed in isolation, might seem like an understandable response to the situation immediately preceding it. Viewed as the actual chain it was, the sequence shows a single original deviation from a defined strategy, compounding, decision by decision, into a complete account loss, with the disposition effect, revenge sizing, and abandoned stops covered in earlier videos, all appearing in direct, sequential combination. It's worth noting how little time the entire sequence took. 6 decisions, compressed into under 6 hours, with almost no pause between any of them, long enough to interrupt the momentum. What stayed with me most, in the aftermath, wasn't the dollar amount itself, though that was obviously significant. It was how rational each individual decision had felt while I was making it. At no point during that sequence did I consciously think, I am about to blow this account. Each decision felt like a reasonable, in-the-moment response to the specific situation directly in front of me. It was only in reviewing the entire sequence afterward, written out, in order, exactly the way I've just described it, that the actual pattern became visible, a single small deviation from my defined edge, compounding through exactly the psychological mechanisms covered elsewhere on this channel. each one creating the conditions that made the next deviation feel slightly more justified than the one before it. The lesson wasn't, be more careful, in some vague sense. It was specific. Every single decision in that chain violated a rule I had already written down for myself. In calmer moments, trade only defined setups, honor predefined stops, never increase size to recover a loss, never remove a stop to manage manually, never average into a losing position. I hadn't lacked the rules. I had abandoned every one of them, in sequence, under live emotional pressure. Looking back at that written rulebook afterward, sitting and used on my desk, that entire session was its own kind of uncomfortable confirmation of exactly what had happened. The reframe is that a blown account rarely happens through one obviously reckless decision that anyone watching would immediately recognize as a mistake. It happens through a chain, usually starting with one small, seemingly minor deviation from a predefined rule, where each subsequent decision is made easier, specifically because the one before it already broke the pattern of strict rule following. This matters because the actual defense isn't vigilance against one single catastrophic decision. It's vigilance against the very first deviation in the chain, the slightly off setup, the slightly moved stop, because that first deviation is what removes the psychological barrier that would otherwise make the second, third, and fourth deviations feel as obviously wrong as they actually are. The second reframe, writing out the actual sequence of decisions after a large loss in the specific order they happened, reveals the chain mechanism far more clearly than simply reviewing the final dollar result. The data is in the sequence, not just the outcome. Step 1. Treat any deviation from your written, defined setup criteria as a hard stop for the day, not a one-time exception. The chain above started with a single, close enough setup, building a personal rule that any trade outside your strictly defined criteria automatically ends your trading for that session, removes the first link before it can start the chain. Step 2. Use hard, broker-enforced stop orders, not mental stops you intend to manage manually. A stop loss that exists only as an intention is one you can abandon under pressure, exactly as happened in decision 4 above. Step 3. Set a hard daily loss limit, decided in advance, that ends your trading day, regardless of the reasoning that arises in the moment. Decide, while calm, the specific dollar or percentage loss that ends your trading day entirely, and treat reaching that limit as non-negotiable. Step 4. Build a specific rule against position size increases following a loss on that same trading day. Decision 3 in the sequence above, increasing size specifically to recover a prior loss, is one of the single most dangerous links in any blown account chain. Step 5. Review your own past large losses for the actual sequence, not just the final number. Write out the actual chain of decisions that led to it, in order. The specific link where the chain started, almost always smaller and more innocuous looking than the eventual outcome, is the one that deserves a hard rule built specifically around it going forward. A $25,000 account didn't disappear because of one bad trade. It disappeared because one small deviation from a defined rule made the next deviation feel slightly more reasonable, which made the one after that feel slightly more reasonable still. A chain of 6 decisions, each individually explainable, that together produced a result none of them would have predicted in isolation. The lesson isn't to trade with more fear. It's to recognize that the entire defense against this outcome lives at the very first link in the chain. Protect that first link. Everything after it gets exponentially harder to stop.